Dinshaw Irani from Helios PMS, who's joining us now to talk more about markets. Dinshaw, thanks very much for your time. What are your thoughts on the market? So one end of the market is saying valuations are getting stretched, it's getting overheated. The other is saying that party is just getting started.
Well, thank you, Ajay, for having me on your show. Basically, our feel is Santa Claus rally is going to continue into the next year, I believe. That's what our feel is. In fact, we were very cautious up to, I think, up to October, because, there were quite a few things which were like triggers for the market. One was obviously the elections, the state elections, but they came out with flying colors. I think the market got more than what it had expected. So that's why that one hurdle was out of the way. And the central elections, it's more or less now decided how that is going to move given the results of the state. The second big hurdle was the way the US rates were behaving. In fact, I think I've said this before also, the fact was that by October, the difference between the 2 and 10 had reduced to some 10 basis points. I mean, the 10-year had rallied up to 5, and rather there was a lot of sell-off in the 10-year paper, and it had rallied up to 5%, which today is down back to around 3.9, I believe, so close to 3.9. In fact, 3.8, 3.9, it's fluctuating between, which was a very good positive angle which was given to the market. I think that also was a big hurdle which went away. And now we also believe that it's time to get into, in fact, when in October we were telling our clients that stagger your investments, today we are telling them to, in fact, straight away in November when the results were out, we were telling them to go lump sum as such. Our feel is that even on the valuation side, given the fact that every single quarter in the last 4 quarter results which have come out, you've seen the upgrades happening in the indices earnings. I don't see this December quarter being any different. I think, again, you'll see some upgrades in numbers because anyway, December quarter was a festive heavy quarter, which was not the case last year as such. So that upgrades will happen again going into this particular next quarter as such. So obviously your valuations, if you look at the last 6 or 7 year averages, we're somewhere there. We're not too far away from this. And why I'm saying 6, 7 years is because Demon came on in November of 16, and after that, one has seen only flows coming into the markets as such, and participation was also increased. So that's what our belief is, that we are not too concerned, at least in the immediate 6, 7 months as such. But our, again, one strong belief is it's going to be a large cap rally driven by large caps rather than small and mid caps, given that the valuations there look fairly frothy.
So, okay, let's scratch that point a little more. You know, people who just track the trailing earnings have a right to call the market expensive. But if I were to ask you about your own portfolio, what levels in valuation terms is your portfolio trading at right now? I'm assuming it would have run very nicely, comfortably in the last 3 to 6 months versus the earnings growth on a blended basis, your portfolio's visibility.
So, good to answer the question. Our valuations are higher than that of the market, which is the Nifty I'm talking about. But our peg is much lower than the Nifty. Our growth rates are much higher. So, when I say peg is price earnings to growth. Yeah. So, since our growth rates are far higher than that of the index that we're tracking, our peg is far lower than that. In fact, what we try to do is try and keep the peg below 1, because you need to see some upside in terms of, and frankly, I mean, we've been there in the market for a very long time. You guys have been there too. And you would have realized that markets are always slaves to earnings growth. If your growth is higher than that of the index, you'll always generate an alpha. And that's what we try to do. Obviously, there are blips in between, but on a longer term basis, you end up doing that. So I hope I've answered your question.
Hi, Dinshaw. This is Anisha also joining in the conversation. We're just discussing how a lot of investors are doubling down on HDFC Bank. I remember having the conversation with you as well, how financials remain one of the key focus areas for you and your liking for HDFC Bank. But the question is, are you willing to double down on your positions at this point?
I think we've already more or less at the peak in our weightages in HDFC Bank. We're close to 10% in our portfolio in HDFC Bank as such. So what you're showing today is the November numbers. After that, it's only been added. I think that's what you're trying to flash on your screen as such. So if you see my December portfolio, which will be out in, I think, a couple of weeks, you'll realize that we've already increased our exposure to financials to quite an extent as such. And we are very comfortable. We are very comfortable given the fact that whenever you, and in fact, that's one thing that we tell all our investors, that what we learn from history is that we never learn from history, but we try to do that. And if you see economies where per capita are moving up, two sectors that stand out are obviously financial and consumption. And these two are the ones where we are totally heavyweight. In fact, if you our consumption, if you look at it a broad brush, consumption holding in our portfolio, which would be real estate and tourism and everything put together, we are almost at 2/3 of our portfolio will be roughly what we'll have in these two sectors. And we remain quite sanguine about it. We're quite bullish on these two sectors.
Dinshaw, when you say you've added positions in the financial sector, and we'll see that perhaps in a week, but which are the names? Are you just adding the positions in the current names that you have, or you've added a fresh name as well in the basket? And is it still the private banking names that you like, or diversifying into PSU? Any more color you can add there?
So basically, we haven't added any new names. We added to our existing names as such. In terms of the PSU banks, we have the largest bank which is there in PSUs with us, and we're quite happy with that because it's a healthy mix of the consumption sector. I mean, it's a consumer-facing bank also, and obviously the project lending bank also, more of consumption than projects as such. The big, I think, upside that everybody is looking in PSUs is obviously that they're more of project-related financing, and given the capex cycle that's going to hit the country, maybe that is where the growth will come through. Our concern is on the balance sheet, and that's why we are fairly very careful in selecting our stocks in the PSU basket as such, and will remain so. So we'll stick to our one single name.
Okay, fair enough. Sticking to some of the same names when it comes to financials, what about consumption? It's Christmas, it's New Year's time. Give us some recommendations. Be generous and kind. Any new stocks, it could be across sectors that you guys are looking at or have added?
So, Aman, I can't give any recommendations because now we love mutual funds, so we'll stick to that. But the fact is that since you mentioned the holiday season, tourism is going to be a one big theme. I mean, in fact, we're talking about domestic tourism. In fact, international tourism still hasn't hit the country in a big way, but domestic tourism has, and you can already see that in terms of the ARRs. I'm sure you must have. I mean, I was traveling a lot of late because of the NFO that we did. Most of the hotels are double their rates. I mean, in fact, more than double the rates. So basically, there's a dearth of quality rooms, and given that the spending power has come back to our consuming public, it's obvious that they look at quality rooms, and that's why it's going to be a stretch. In fact, I think there's another year or two. In fact, what our feel earlier was that probably this will be a peak in terms of ARRs. But looking at how the situation is, we think there's still more growth left in that, and obviously certain hotels are adding rooms. They'll benefit a lot going forward in the next year.
Are you adding those names? These hotels which are adding rooms, are you adding those names in your portfolio as well?
Yes, we are. We are adding.
Sure. Okay. So, Dinshaw, on that point of real estate, I mean, every day we are waking up to positive news on real estate. In Delhi, Amrapali is selling a lot of inventory. NBCC is selling Amrapali's finished inventory in the middle income. Godrej Property is selling massive 48-50% growth in the luxury side in Gurgaon. Where exactly in the real estate cycle are we in your view? Because we've been seeing it for 2 years now already.
So, Ajay, actually, we got to be very careful here because, we don't want to get stuck with debt-heavy companies because if the cycle turns, there obviously will be that'll be a big pull down for these companies. So we're very careful in our selection process. However, what we've looked at, and in fact, that is what we tell everybody, is that even in the real estate space, you have to look at a company which has a healthy mix of all, not only residential, but also in terms of commercial, in terms of rental, because you need, retail, because you need a healthy portfolio of leasing portfolio, which can be, at some point in time given out as an offering as such. So that's why we're very careful in our selection. In fact, and the real estate play that we have looked at is only a fairly localized play, mainly into luxury housing. So that's what we want to probably do that. I mean, it's based on the NCR, so I don't think you need to guess too much to understand which stock I'm talking.
Yeah, I don't think it needs much guessing. If it's NCR, there are limited players, and DLF is something that comes top of mind. But there are a lot of these, tactical ideas that seem to be popping up. You're just discussing, the chemical sector, which is suddenly seeing a lot of buying interest as well. Would you want to bet on any of these, names for, let's say, a one-year view or something at all, Dinshaw? I know it's a mutual fund, longer term, etc. But there's always that one portion that you keep in for, these momentum plays as well, right?
So, Aman, the problem with the chemical sector is that everybody's betting on the fact that it's a China plus one play. But mind you, China came out of that sector because of ESG, and we also are not too comfortable with these kind of companies. But the fact is that even on the valuation front, they're fairly stretched, and they're yet to prove themselves, frankly. I mean, we haven't seen much of upsides here. So forget about the pricing bit. I'm talking about the in terms of financials. So we would rather stay away and then be carried away with this, because there are quite a few ideas. So it's, I think what people believe is they're having a FOMO, I mean, fear of missing out. But the point is that there's so many stocks in the market. In fact, we've seen that consistently around a third of the market does fairly well, and that's like a huge amount of stocks. So we have enough ideas to pick from rather than go in and try to grab something which has just got momentum on side.
Dinshaw, out of the QSR space, some of the names like Barbecue Nation, Sapphire, or even Devyani has just started moving. Have you looked at some of these names which have not done well? In fact, Jubilant also for several quarters have been complaining about anemic growth in same store and all of that. Where is is it competition, heightened competition? Is it inflation? What exactly has led to such weakness in same store, etc.?
So QSR space is very interesting. I think it's more of the names that you mentioned, which is having a problem right now, is mainly seeing a lot of local competition. I mean, as in you have a lot of options. When you open up a Zomato or a Swiggy, you see so many pizza guys which are there as such, and you would want to try out newer names, right? So I think that's where the problem is. Wherever the QSR is more of say a high street based or say a mall based kind of QSR. I think that's the one which you're looking at, because we have 65 crore youths in the country today, and I'm sure they're always looking at these options of picking up stuff when they're moving around, and impulse purchase as it's called. So I think those are the plays that you're looking at. We have only one player in that space, and I think we're quite happy with that. Plus, we have a supplier who supplies to that player, which is a listed player as such. A part of his sales is through that. Plus, he's got a brand ownership also fairly well known in the market. So these are the only two, I would say, QSR and its derivative that we have in the market.
That does give us a hint as to which names could be. But, real estate, again, we talked about the entire NCR region and perhaps DLF as one of the names. But what about the entire supply chain? And I'm talking about cement, consumer durables, cables and wires, and the rest of the building material. Is that something that could be an interesting sector to watch out as well, Dinshaw?
That could be, because these are, again, derivatives. But, I mean, in the commodity players that you mentioned, I mean, cement, basically, we do not like that space. We think there's enough capacity and beyond, just because of the price discipline that they have, they're managing to go ahead. And you've seen that, right? There've been pullbacks in prices and all that. So it's fairly not a comfortable space to be in. Or anyway, the players are fairly stretched on the valuations. You can't give out 40, 50 times forward earnings to commodity players, right? So that's why we're away from that. In terms of the other, like the tile guys and the cable guys, again, our comfort is not there purely because of valuations. I think they've done a fantastic job in terms of earnings growth and all. But even despite the growth, the valuations are fairly stretched in that space and not too comfortable today.
Have you looked at anything amongst the recent listings or the recent IPOs?
No, Aman. Actually, it's been that actually scares us. Frankly, I mean, the IPOs, the way the frenzy is there in that market. I think mainly the retail guys are getting sucked in there because it's IPO, right? So they expect a pop going forward. But the fact is that if that doesn't happen, you at least a very bad taste in the mouth of new entrants in the market. So that may just put off a few, but frankly, I mean, I think the valuations there are fairly stretched whenever the IPO comes. Normally you need something like 20-30% on the table when IPO comes. And when they come at, say, par valuations to the listed entity or even a premium to the listed entity, there's no way you can look at a pop when that happens. So that's why we've been very careful. We haven't participated in any of the IPOs that have come through of late.
You're right. Dinshaw, I'll just like to go back to some of the supply chain companies to these QSR space. One company which comes to mind is a cookie company, but also supplies buns. I mean, they were to this entire space. But I don't want to talk about their domestic play. Increasingly, in their commentary, one is getting a sense that export could become a big angle for them, or perhaps supplying to some of the really big retail operators in the West, be it Europe or even US. Do you think this could actually be a new chapter for some of these companies and give much more longer term visibility, 5 to 7 year kind of visibility? Right now, exports is a small portion of their business.
No, Ajay, you're right. Actually, that's what excites us about this space also. In fact, I think you're referring to the same gentleman, the stock that we have in our holding as such. But the fact is that, yeah, that's the one you're talking about. So, so the fact is that, look at it this way. I mean, if India has been the toughest market for QSRs, right? These guys are supplying to MNC players out here. Yeah, and they've been very cost conscious. In fact, I remember meeting one QSR player who was an MNC, and he was telling me that he even counts the number of the seeds on the bun to make sure that the quality doesn't go awry, even though they're cutting the price on the buns as such. So that way, so that's the kind of control these guys have on the cost. And despite that, the players who are suppliers to these QSRs have managed a lovely, I mean, fantastic margin as such. So it's obvious that the global MNC will always look at them as a potential to outsource from here as such. So I think that's one thing that we played with. And frankly, I mean, commodity prices are the only ones which create a bit of an upheaval, and that's what happened in the case of this particular supplier, because wheat went up because of the tussle between Ukraine and Russia. We waited for the price to correct even before we got in as such, because we realized that was the only overhang for the stock, and whenever wheat prices come into norm, they'll go back to their norm. So that's what we waited for, and I think we're very bullish on that stock.
Okay, Dinshaw, on that note, we let you go. Appreciate you making time and speaking with us.